Well, there's no way that you could have missed those alarm bells. 2 weeks after the Monetary Policy Committee had its meeting, the central bank has released the minutes of that meeting, and all members of the committee seem to have unanimously voted to hike the policy repo rate by 50 basis points to 5.4%. Those minutes also list the members' assessment of macroeconomic factors. Let's find out what exactly has been said in the minutes of that meeting. My colleague Ankur Mishra has been poring over those details, and he's joining us with the key highlights. Ankur, walk us through them, please.
Yes, all important MPC minutes are out, and once again RBI Governor Shaktikanta has focused on whatever it takes approach to deal with the current uncertain environment. Also interesting views have emerged from Professor J.R. Verma, who has questioned the withdrawal of accommodation, the wording of the stance. He says that it is better not to give any guidance, rather to give a confusing guidance. In fact, he has also said that a plain reading of the MPC resolution suggests that we are moving towards 6.5% terminal repo rate. However, he has also said that whether or not it is 6.5% terminal rate, but it is definitely above the current rate of 5.4%. He says that there is a high likelihood of further front-loaded tightening without restricting the freedom of MPC. Other members have also expressed the concerns on high inflation, although it has moderated a bit and it seems that it has peaked out, but it definitely remains in the uncomfortable regime. RBI Deputy Governor Michael Patra has said that the global outlook remains increasingly uncertain and tilted downward risk remains. Also, one of the important members of the committee who is involved in the MPC drafting, RBI ED Rajiv Ranjan has said that global geopolitical scenario, the source of the price shocks continues to remain unsettled. He has also said that the front loading of policy actions is expected to strengthen the monetary policy credibility and temper the need for aggressive rate hike in the future.
All right, Ankur, thanks very much for walking us through the highlights of the minutes of the MPC's last meeting, where they've gone ahead and hiked interest rates, a 50 basis point hike. Let's decode what they are saying. Mythili Bhusnurmath, our consulting editor, is joining us to help us do that. Mythili, great to have you on India Development Debate tonight. You know, when the governor says that inflation remains unacceptably and uncomfortably high, do you read it as a continued aggression when it comes to hiking those interest rates?
Well, yes, certainly the RBI is, in all probability, going to continue hike interest rates. The question is whether will they continue to increase by the same quantum, the 50 basis points the last time as well as the previous time. So that really is a question mark, whether they will temper the pace of increase. So I think the rate hikes are a given the fact that inflation is a big cause of worry for the RBI. Very clearly, as seen from the minutes, all the members are unanimously agreed that even though inflation has plateaued, seems to have peaked, it still remains a major concern, and the only way you can get it back under control is by front-loading interest rates. In fact, that was a unanimous decision. The only person who disagreed, the lone wolf as it were, in the past as well, Jayant Verma, he has disagreed only as far as the stance is concerned, where he says the focus on withdrawing liquidity could be carrying things too far because it could result in people interpreting that the terminal repo rate will be about 6.5, and given the uncertain global scenario on the growth front as well, that could perhaps be a little unwise. But as far as the interest rate and inflation itself is concerned, all the members are on board. There's only a question of difference of degree, and by and large, in any case, as I said, the MPC, the internal members, of course, have always been guided by what the governor has said. It's tended to be groupthink. As far as the others are concerned, both Shashank Bide as well as Ashima Goyal have also tended to go along. Jayant is the only one who's often struck, I wouldn't say a discordant note, but a slightly different note. And this time too, he has said that. Yes. So I do think, as you said, that the interest rate hikes are here to stay.
Also, Mythili, the MPC member Rajiv Ranjan has said that the risks to the global economy, which were initially perceived as stagflationary, are now increasingly surfacing to be that of an outright recession for most economies. As far as India is concerned, the RBI Deputy Governor Michael Patra has said the global outlook becomes increasingly uncertain and tilted by downside risks. He has also said, and that's the part that is disconcerting, that the probability of a recession or a hard landing has risen to levels that precede actual recessions of the past. So how do you see the probability now of a recession hitting India, which Deputy Governor Patra says is at the highest level it has ever been?
No, I think what Michael had in mind was essentially about recession in the West. India has always held that we are not anywhere near a recession simply because we are growing as we are, because we are still stated to grow this year at 7.2% as per the RBI's own estimates. And recession, mind you, is defined as 2 consecutive quarters of contraction. So we clearly are not in the recession territory. So while the rest of the world, particularly the Eurozone, is clearly heading for recession, as far as the US is concerned, technically, yes, you could say GDP has contracted for 2 consecutive quarters, but when the US job market is expanding the way it is, it clearly is not in a recession. So I think the jury is out as far as you can call the US being in a recession, but India, I think, is perhaps more likely to head for a stagflation rather than recession. And I think Michael was talking about recession in the rest of the world, not as far as India is concerned.
As far as India is concerned, if we keep going at the same aggressive rate to attack inflation, there are going to be concerns on growth. In terms of what the government has done and it would possibly do to ring fence growth, how do you think? What are the tools do you think that will get employed, what they haven't done already?
Well, as far as the RBI is concerned, in any case, the ability of monetary policy to spur growth has always been very limited. It's been debatable in the past as well. As particularly, you must remember, as far as India is concerned, both food and fuel are completely outside the RBI's ability to control inflation. So it's only the remaining very small part, core inflation, that means excluding food and fuel, that the RBI really had much of, whatever little control monetary policy had. RBI was only able to control those. And you must remember also that monetary policy is a very broad brush tool, acts with a long and very often indeterminable lag. So monetary policy's ability is limited. The ball here is largely in the government's court through spurring public investment. And that is what the government has been trying to do. It all depends on how revenue holds up and whether the government is able to continue that capex to ensure that growth remains on target. Of course, the big question mark right now is about export growth. Last year, exports contributed as much as 50% of overall growth. This year, if you have global growth slowing down, we cannot expect that kind of support from exports. So I think it is going to be difficult for us to sustain that 7% growth that we are likely to see last year and this year going forward. But certainly we will be at least in the range of 5 to 6%, and that is good news by any reckoning.
Exports, in your reading, with the kind of forecast the RBI is making, Mythili, how do you see industry coping with higher interest rates and perhaps a hit on consumption levels because of high inflation in the future? Do you see the trajectory of industrial production change perceptibly?
Well, I think industry so far, if we're talking about the organized industry, has held up quite well. You see corporate bottom lines, they have in fact improved. But now as input costs increase and inflation hits and demand is likely to slow down, I think large organized sector will also feel the heat. So clearly we will not see the growth in manufacturing. Of course, in the past also we've not seen much growth in manufacturing, to be honest. It's just that bottom lines have held up. But I think that's going to also be under pressure in this year going forward as inflation begins to hit demand.
So when it comes to attacking inflation with the kind of moves that the RBI has made, obviously as far as the Indian currency is concerned, we've seen that come under a lot of pressure. The trajectory that the rupee will take from here is also going to determine how we do as an economy for the kind of trade that we do as well. How do you see that piece moving?
Well, Vikram, the problem really with the rupee-dollar exchange rate is that the weakening of the rupee is largely now a function of the dollar strengthening. And as the dollar strengthens, the rupee is bound to weaken. Ordinarily, this should help support exports. But the problem is that a great deal of our export also has a heavy import component. So to that extent, I think it is really going to hurt us because imports will become more expensive. Remember also, the biggest problem with the weakening rupee is that it has huge impact on imported inflation, particularly as far as fuel inflation is concerned, because we import almost 80% of our oil requirements. So a weakening rupee good news really for the Indian economy in the present circumstances. The support for exports will not happen, whereas inflationary impact, the adverse effect on inflation will be quite damaging.
Mythili, there was an article that was published in the RBI bulletin that created quite a flutter, and we spoke about it at length yesterday as well. But I just want to get your clear perspective on the possibility of privatization of public sector banks, because while the government is going to try all possible methods, and we understand the PMO is now going to have that review meeting to understand whether we are going to meet our FY23 divestment targets, as far as the possibilities that stand around the privatization of public sector banks, how much is that likely to change the discourse, as it were, for the banking sector and what it's supposed to do? Because by and large, the private sector is going to chase profits. When you talk about financial inclusion, it talks about, like what you mentioned as well, spurring people's investment capabilities. Now with the banking sector likely to go more private, more consolidation of public sector banks is already underway. How do you see that changing the nature of our economy?
Well, Vikram, it's interesting what you spoke about, because, you know, the article in the RBI's latest bulletin kind of defending public sector banks and kind of speaking out against privatization of banks is an interesting case of RBI perhaps, you know, trying to demonstrate its independence and then actually discovering that it is not all that independent particularly. In fact, it reminds me of the words of a former governor of the Reserve Bank of India who said, yes, of course, the RBI is very independent and I have the permission of my finance minister to say that. Of course, he said it a bit in joke, but not entirely in jest, because the fact is that while the Reserve Bank has full operational independence, when it comes to policy, it is clearly the government that calls the shots, as it should be. But the RBI article, the article in the bulletin, is entirely right in saying that public sector banks have played a tremendous role in ensuring, as you said, social inclusion, whether it was demonetization, whether it was during COVID. It was the public sector banks that really stepped up. Even when it comes to infrastructure lending, though agreed, many of the loans that they made to infrastructure companies did finally end up as NPAs. During the days immediately after the 2008 crisis, when the economy was going through a huge crisis, it was this lending by public sector banks that really shored up the economy. So I think public sector banks are very often sinned against rather than sinning. And private sector banks have always been watchful only about their profits.
Yes.
Even if you look at the simple case of COVID, look at the number of public sector bankers who gave up their lives, who died in the cause of their duty, ensuring that banking continued to reach the people. Compare that with what happened with private sector banks. So I think there is a lot to be said on both sides. Private sector banks are good for profits. Public sector banks are good for the people. All you really need to do is to ensure that they continue to remain efficient by ensuring that arm's length distance between government and the management of these public sector banks.
Absolutely. There are so many points to discuss as far as the RBI is concerned. The minutes of the MPC's last meeting has created all these talking points. Thanks very much, Mythili, for joining us. And of course, we'll continue to do so in times to come.